Hey guys, welcome back. It's Key Trades, and today I have an awesome video for you. Another foundational video, just something that you could go by, especially if you like analyzing multiple time frames. So this is a multiple time frame analysis formula. Okay, so we're gonna look at three different time frames to find a entry and just basically a system to execute. All right. So what we're going to start off with is the foundation, the basics. Okay. So, and we're going to be day traders today. This can really work with any style of trading. If you're a day trader, scalper, swinger, whatever. But we're going to focus on day trading today, and I'm just going to show you the formula so you can just get an overall feel of it. All right, so the highest time frame you look at for a day trader, and I'm not saying this is like standard across the board. I know some day traders that look at the daily, the 4 hour, whatever. But for this particular setup that we're looking at today, we're going to start with the hourly. This is going to be your king. This is going to be your everything. Okay, and that time frame is going to be where you look for structure. Okay, and then you have a second time frame that you look at, and that's going to give you points of interest, and this will be your 15-minute. So this is going to be just the area of interest or points of interest, just an area where you're going to find to get in at. Okay, and then the 5 minute, this will be your entry time frame. So this is the formula pretty much. You have your hourly time frame is where you discover a structure, and you develop your bias. Okay, the hourly time frame will be the first time frame you look at when you come to the charts, and this will literally determine your bias, and it will determine if you're going to take opportunity or not. Because if the market isn't trending, or is it just in a range, and our price is tight, there's no volume, structure can really give you the answer to that. Okay, so that's why the hourly time frame is the first you need to look at, and that's why it's so important. So once you develop, hey, yes, there's an opportunity, and hey, yes, I do have a bias, then you move down to your 15-minute time frame, and then from there you look at points, areas where you are expecting price to come to or react to, so you can execute and get in. And then once price hits those levels, you go down to the 5 minute to see what candlestick formations are forming, and what momentum is forming at these levels, so you can execute and get inside the trade. All right. So now that we know the formula, let's take a look at gold. And this is hindsight, but hey, I'm just showing you the formula. And once you have these tools, you can translate it to the charts. So I guess we are a day trader and we are pullback traders. Okay. This formula can work on people that like pullbacks, people like continuations, people that like breakouts. But today we're just going to make it like simple and just focus on pullbacks. Okay. So as you can see, we the momentum now is bullish, but let's just make sure that it is bullish. The bias is bullish on the hourly, and we just define that by what structure is telling us. So as you can see here, um, we made this low, okay, from this high. Then we made another lower low from this high point right here, okay. And I actually just want to say that this high point made this low too, okay. All right. But price has broken above this lower high that made this lower low. So that just gives us caution that hey, the market, the momentum has shifted, and the bulls are, they're coming in heavy. They're breaking structure. All right. So this would be right here. This would be the change of character, and an opportunity to look for a bullish setup. Okay. So from here to here, this is when momentum has shift. Okay. So we have this push up. So we have our structure defined. Our bias is bullish because we broke structure to the upside, and we are anticipating as pullback traders. And again, this isn't like be end all be all. You don't have to be a pullback trader, and you don't have to be a day trader to look at this. Just focus on how I'm breaking down the formula, and then also see how you can apply that to your own strategy or your own style of trading, and see how the confluence through the multiple time frames can help you. So we have a break of structure. So we're anticipating that we have the momentum going up. We want a pullback because that's where we find our entries, and then we want a continuation to go up. Okay. So I'm coming to the charts right now, and I'm like, okay, boom, got structure, got my bias. We're bullish. Let me go down to 15-minute. Since I am bullish, I'm a pullback trader. I am only looking at support levels to get in. And this is looking at this trend right now, this current momentum, and let's see if we can find some support levels. Okay, so here's one right here. Looks like we kind of bounced from already. And then we have another one right here. All right, and there's another one right here. So we have a lot of support levels, okay? That is a possibility that price could, bounce back from. All right. So going back to the hourly, okay, you would want price to come back about 50, 60% of the move, or less. You want it to really trace back a nice amount to continue to take price up. Okay. So all we have to do now is basically wait until price comes into our areas of interest. Okay. And these levels are areas of interest. All right. So let's just wait and see what happens when price comes down to our areas of interest. Okay, so it kind of went fast, but okay. So we see that price came down into this area of interest, right? It came all the way down into it. What we're going to do is go to the 5 minute and really see what's going on. So just because price is in our area, that doesn't mean that we buy, right? It just simply means that, hey, we just need to be able to read what the candlesticks are telling us to let us know that the buyers are back. They're back and they're in control. Okay. The buyers are back and they're in control. And they're ready to take this thing up to for a continuation. So none of these candlesticks says that this, definitely none of these candlesticks, even this nice momentum candle is a great candle, but it's not above the level that we want to get into. All right. It's not above the level that we want to get into. So we are going to wait until we get a close above. All right. And then right here, we have a close above, a nice engulfing candle, and a close above. And that is our go to. That is what we want to see, an engulfing candle closing above our area of interest. So we got that. So this would be our entry. All right. So just to remind things back a little bit, let's put this formula together. We have an hourly structure. It gives us a bias. Okay. We have an hourly structure that gives us a bias. It tells us that there is opportunity. We go down to our 15-minute time frame, and that is our time frame where we seek areas, points of interest to get in. And then we go down to our entry time frame, which was the 5 minute, and that is where we execute. Okay. We just need confirmation. Okay. And we got the confirmation through, what did we get the confirmation through? A bullish engulfing candle closing above our area of interest. Okay. So now, once after you get in, how do you know what targets to go for, and how do you know how big to put your stop loss? There's a million and one ways, but I love using the grounded risk tool to just let me know where to get in. I'm not necessarily where to get in, but after I've entered how far to put my stop loss and then how far to put my take profit. Okay. So actually let's rewind it back a little bit more because I want to see exactly what it said when we got in. Okay. So it gives us a tip. It's a slower phase. So TP1 and 2 and TP2 um are targets. It's favoring these targets because exits are tighter at this moment of time. So TP1 is green, so it's basically letting you know that this is a definite target to go for, and TP2 is somewhat of a risk. So let's just see what happens if we just go for TP1. And I can't get it exactly on that, but we'll do it in here. So it's 228.5. Oh, I can't do points. So we'll just do 228. No, that's not right. 2285. And then we'll do 2285. Okay. So let's see what we got. All right. So it hit our target one. Let's see if it would have hit our target two, which was and this one would have been a little bit more risk, but it's medium risk compared to the fully confident green risk. So it did hit our TP2 also. All right, so let's see if it hit our TP3. And it's really up to you on which target to go for, but also know if you're going to go for a higher target, just manage that trade. And it did hit all three TPs, which is good. Okay? But my biggest thing here is that trade management is so important, and I know this doesn't have a lot to do with the formula, but like I said, there's so many things when it comes to trading. All right, you have your exit strategy, you have your entry strategy, you have to have the foundation of understanding market structure. There's trading psychology. There's just so much to it, right? But I love the grounded risk tool because it lets me know, hey, with the volatility or even the volume or even the news or whatever is happening, the narrative of the market right now is, hey, we're at a slower phase right now. And rather than risking everything, just go for TP1 or TP2. Okay. And it lets me know how big my stop loss should be. Why put my stop loss below this low if my stop loss only needs to be up here? You know, and at this point, since I have a smaller stop loss, I can technically risk a little bit more and things like that. So I love this tool for that, but that's besides the point. I just wanted to show you all this formula and how powerful it can be when it comes to your day-to-day trading. It can be for swing scalps and for day traders. It also can be used for breakout traders, pullback traders, continuation, whatever type of trader you are. Multiple time frame analysis can be really, 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 really confusing. It can be so confusing, and I love this formula because it just gets straight to the point. I look at the highest time frame that I'm going to look at, and that determines my bias, and that determines if I'm getting in a trade or not. Okay, if the highest time frame, the structured time frame, if that's not the king, if that's not aligned, or if I'm not feeling that, there's no need for me to trade. Okay. But if I see opportunity within my structured time frame, I can go on to my areas of interest to seek um opportunity to get in and execute. And then if once price gets to those areas, I go down to my entry time frame, and that is where I execute. Okay. And that's where it gets a little bit more tedious, because that's when you have to know where you're going to put your stop loss. That's when you know that's where you have to know what targets you're aiming for, etc. So I hope that this video helps. And if you do like this in particular, the subject of this multiple time frame formula. If you like this, I can do more videos on it. I can do scalpers point of view. I can do it from a point of view of a breakout trader, whatever. Again, my goal is just to help traders build a foundation. You know what I mean? Sometimes we don't necessarily need a strategy off of rip. You know, as traders, sometimes we just need a foundation, understanding, some clarity of how to navigate through the different time frames and how to navigate through our executions and all that other stuff. Okay. So I'm not trying to give a strategy. I'm just trying to give you a foundation. So once you have a foundation, you understand how to apply your strategy and how it applies to your setup or whatever. So if you like this video, please like and subscribe, and please comment what would you like more of. Okay. So thank you so much. And I hope that everyone has a great day.